Hi, this is Jason Coddington Wealth Advisors, and in this month's version of the June 2020 Student of the Market, we'll be looking at historic volatility, what we can learn from diversification, and what typically happens after bear markets. So go ahead and hope you enjoy this educational format of what we can learn about capital markets and how we can behave accordingly. Hi, this is Jason Coddington, and we'll be looking at the Student of the Market for the month of June 2020. So let's get started. First is we've experienced historic market volatility. And how do we know that? Well, the average number of 4% days in a year from 1928 to 2019 has been 3.2. That means that the market, only 3 times a year does the market move up or down 4% in one day. Well, this year, from January 20th to May 31st, we've experienced it 16 times. So if it feels like it's been volatile and bouncy and more stormier than other years, it definitely has. But we'll learn that staying invested is typically the best response. Next is bear markets. So if you look, there's a history of bear markets. Going back on this chart, we go back to 1956 and look at the bear markets since then. And if you look, the key point here is what happens after. So typically, the average bear market's been a 35% drop, but at 1 year following the bottom of that bear market, 41% up, and then 3 years following, 16% up. So again, future performance or past performance is not going to guarantee future results, but it's something to consider. So that previous slide that we saw where we had a historic market volatility, staying invested has historically proven the right case, because if we look even back to 1987, 1 year after, 21%, 29%, and then of course 07, 68%. So even though we're down, staying invested typically is the right course of action. This next slide, the big dispersion in asset class returns. And really what we're looking at here is diversification and the importance of diversification. So if you were just in, let's say, financial stocks, you can see that you'd be down 24%. If you were in just government bonds, okay, you would be up 19%. But the point here is that certain asset classes perform differently during times of volatility. And what we strive to do as advisors is to help you have diversification across all asset classes, so you're not stuck in just one. Next is style. So there's two types of styles of stocks. There's growth and value. Growth are companies that are continuing to grow. These would be larger companies or sometimes companies just getting started. And then you have your value companies, which have been around quite some time and are providing, have good balance sheets, good cash flow, good earnings, historically paid dividends. And if you look, there's only been 2 times in history where the rolling period of 10 years has been in growth has been better than value. So what this is telling us is that growth has been in style, and it's likely based on history that value will start showing up as a style. So as we review portfolios, we may be looking to add value to those portfolios to increase the opportunity there. Next is emerging markets versus the United States. So emerging markets are basically economies that are just getting started or not as developed as, of course, the United States or Europe. So these are companies, the large ones are Brazil, Russia, India, and China. And if you look, historically speaking, once the gap is the widest between United States stocks and emerging market stocks, you can then see following that gap, emerging markets tend to outperform. So if you see that right now, the United States has outperformed quite some time. And when that gap widens, which it has here, typically what happens is that there's a trend. The next rolling 10 years is where emerging markets. So again, we'll be reviewing this. There's a lot of volatility in emerging markets, but it may make sense to add emerging markets to portfolios to provide some opportunities. The next piece is bonds. And so this is important in the sense that if we look back in history, this is the 8th best start of a year for bonds. And so what does that mean? So this is the first 5 months of the year for 2020. And if we look here and then follow what follows, historically speaking, bonds, with the exception of 1 year, have had positive returns the remaining 7 months. So we don't know what's going to hold for 2020, but it's not necessarily, wise to get rid of bonds just this second. So I know the interest rates in bonds are low, but they still have a place in your portfolio to reduce risk. And as we saw from previous slides, the diversification that's required is important because bonds have been the top asset categories. So maintaining bonds in your portfolio is important. And so we want to maintain that and then just consider, they may have an opportunity to still be positive even in the next 7 months. The next piece is, where are we getting return as it relates to income in portfolios? And these are all the different asset categories that we can look at for income from our portfolios, such as dividends or interest or bond yields. And if you notice, there's only 2 that have provided income and still have been positive. And those are U.S. bonds and convertible securities. So, and everything else is negative. So if you might be still getting income from these positions, but you can see that your value has dropped. So we'll be monitoring this going forward, because you want to be looking at, okay, where can I get income that's decent, but at the same time not have fluctuation to my principal. And that kind of wraps it up for this month's Student of the Market, and hope this has been educational and helpful for you and will help guide your decisions as you plan for your financial goals in the future. Thank you so much. And as always, if you have any questions on how this may impact you individually, please don't hesitate to contact us. We would look forward to helping you. Thank you. Well, that's it. And thank you. Hope you found the information valuable, and stay tuned for next month for our July 2020 Student of the Market, where we look to see if equities have rebounded to their original January 1st, 2020 values. Thank you.